We should
What
have
what
that.
what should their optimal monetary policy be in 2024 to engineer a soft landing?
Well, I'm a fan of the Taylor rule. It's been around for a long time, and I think if they keep close to that, they should be fine. And it's in their reports. They all knew about it. They focus on it, and the financial markets focus on it, and other countries focus on it. It's not the only way to do things, but that's what I would feel most comfortable if they bring the rate down according to the Taylor rules.
Just how many rate cuts is the Fed likely to engage in next year, and what is the optimal level of interest rate that is needed for the economy to grow sustainably without inflation coming back and overheating once more? We're discussing this and fiscal policy with our next guest, John Taylor. It's my honor and privilege to introduce Professor Taylor to the show today. He is the professor of economics at Stanford University and the George P. Schultz Senior Fellow in Economics at the Hoover Institution. Professor Taylor served as the Undersecretary of Treasury of International Affairs at the U.S. Treasury Department from 2001 to 2005. He is best known for developing the Taylor Rule, which identifies the optimal interest rate for reaching the Fed's inflation target, which has been applied by central banks all around the world. Stay tuned to hear what Professor Taylor has to say about the economy and what's next for central banks. But first, a message from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Professor Taylor, an honor to host you today. Welcome to the show.
It's good to be here. Thanks for inviting me. I appreciate it.
I appreciate you being here. I want to ask you about your economic outlook and what the interest rate should be next year according to your famous Taylor rule. But first, I'd like to ask you about some of the topics from your latest book, Getting Monetary Policy Back on Track. Is the Fed back on track now, Professor? Let's start with that.
Well, the inflation rate's not at 2%. Remember, the 2% came from the so-called Taylor rule, and that's what the Fed has focused on, but it's not back to 2%. It will be, we hope. So I think they have to be a little careful at this point that they bring it back to around 2, which is what their goal is. And I think once that's occurred, the unemployment is quite low. We should be all set. And I think that's really what we should be looking at. And don't overdo the ease, but make sure we get the 2%.
Is the current Fed administration at risk of running similar mistakes as previous Fed chairs in the past, which is to say they've over-eased or is about to over-ease and cause inflation to return?
Well, I think the evidence in favor of that view is that they had the interest rate at 25 basis points when the inflation rate was very high. It got to 9.1%, remember, and that was way off. And so we don't know all the reasons they were so low, but that was not following any kind of rule or strategy. It was maybe concern about what happened in the pandemic. It may have been an overflow about that. It may have been political appointments. We don't know all the reasons, but I think that caused some damage, no question about it. But now that they are closer to what we think the rate should be, then we should be all set. But I think that we're still sacrificing some of the danger that was caused by those low rates.
Jerome Powell has signaled in the last press conference that the Fed may cut rates by up to 3 times, perhaps more. Certainly the bond markets are pricing in more than 3 cuts. Do you agree with, first of all, the market and what Mr. Powell has said?
So it depends on the inflation rate, whether it stays down. I think it will continue. I believe in the so-called Taylor rules, named after me. It's been around 30 years. And it's a pretty good guideline. All the FOMC members know about, all the central bankers around the world know about. Sometimes they get off for political reasons, and they were off for reasons we don't know for sure. But now they're pretty close. And I think as the inflation rate, if it continues to come down, especially if it stays down, they'll be able to low rates. And there's a pretty good guideline about what to do. And so I follow that more than ever. And I think the Fed and other central banks are as well.
I think it's a good segue to talk about the Taylor rule itself. So the rule ties in the inflation rate with the interest rate. So the relationship between the interest rate and the inflation rate is defined by this rule. Can you walk us through the logic and the formula and how it works?
Sure. The focus is on the interest rate. It used to be, before then, the focus was on the money supply, but I decided that the interest rate was what the Fed and others paid attention to. So that's what the research focused on. So the interest rate will be higher if the inflation rate is higher. And if the inflation, there's actually a coefficient, 1.5. When the inflation rate goes up, the interest rate should go up by 1.5. And there's other variable, as you mentioned, the unemployment rate. The unemployment rate is in much better shape than it was before. We're a little bit worried about it picking up again. But I think that's the main focus, is the unemployment rate and the inflation rate. And they're both suggesting the Fed could come down. But let's be careful. Let's be sure we know that the low rate in the last couple of years before then, I think, was one of the reasons why the inflation rate got so high. It wouldn't have gotten so high if the rate had followed the so-called Taylor rule. We would be in better shape. So that's where it's focused. It's come out of research. It didn't just make it up. It's been many, many years of research and scholarship that has led to this.
I would like to actually ask you how you came about doing this research and finally formulated this rule. So I'll just present the formula for the audience and put it on the screen here. So
Okay, sure.
the interest rate here is defined as as P, the current inflation rate, times R, the assumed equilibrium rate, times 0.5 of the inflation gap, which is the current inflation rate and the Fed's target rate. And then plus 0.5 times the deviation from the current GDP and the target GDP. Am I correct so far?
Correct. That's correct. Yeah, you went pretty fast, but that's pretty good.
Well, first of all, how did you come up with R? I'm curious as to understanding R first. The assumed equilibrium interest rate. What does that mean?
That's what the interest rate should be when the inflation rate is at its target and the interest rate is at normal levels. So it's 3 or 4%. And it's really based on experience, based on other countries, not based just on the US. But that's the factor that causes the rate to be 4% normal.
Professor, why do we have to assume that an equilibrium inflation rate, which is to say an inflation rate that I guess is optimal for economic growth, has to be positive and not zero or perhaps even negative?
Well, there's been so much research on that. And what is good news is so many central banks around the world have chosen 2% to be the value. Maybe it should be 1.5, maybe it should be 1, but 2, there's a lot of agreement about that around the world. And not every single country agrees with that, but many do. And I think that's the important thing. If you could have a global agreement that, say, 2%, 2% is what it was in the Taylor rule, to stick with that would be much better shape than if it goes to 3, we need to tighten. If it goes to 1, we need to loosen, and it's pretty clear.
Do you think all central banks, at least for the developed countries, should all be targeting 2%?
I think it would work very well. I think it would work very well. Of course, some of them have a long way to go. Argentina, for example, has a new central bank governor. They're going to try to reduce the inflation rate. It's a big job. And we have lots of African countries that interest rate is the inflation rate is high, Latin America. So there's a ways to go. But I think the experience of the US and other countries, Europe, is very promising. And Japan as well.
Well, since you brought up Japan, I'd like to ask you about Japan's experiences throughout the 90s and early 2000s. Do you think the central bank should have raised their target inflation rate to far beyond 2%? Because clearly they had a period of deflation, and one could
Yeah,
argue that the central
to
bank
answer
should
your
have been more
question,
aggressive.
I think it would be wise. They have a new central bank governor there who's paid a lot of attention to these kinds of strategies and these kinds of rules, and I think that's where they should be going. And there's an advantage, quite frankly, if countries all have 2%. maybe not exactly, it's hard to hit exactly, but I think that would be an advantage, in which case you'd have a global world situation where there was, say, close to 2%. That'd be an advantage. And 2% is easy to remember. And it's a value that's not zero, but it's close to zero, and it works pretty well.
And now the deviation from the current GDP to the target GDP, again, how do we define the target GDP, Professor?
Usually, the best way is to think about some normal level of employment or normal level of GDP. Sometimes it's called potential GDP, sometimes it's called the normal unemployment rate. And so you need to have a sense of what the normal situation is in the economy. And that's where the 2% comes from. You have a 2% is a goal for the inflation rate, and you have maybe a little bit more for that for the others, and it works pretty well. So the 2% is it could vary from different countries. It could be very high in other countries as well.
Well, as you know, since 2020, the inflation rate in the US has greatly deviated from the Fed's 2% target by a wide margin. It's currently still not quite at the 2% target. Do you think permanent distortions to the economy have been made?
I think there are always distortions. There's price shocks. There's favorable developments on the international trade side, and they will affect the best guess of what the unemployment rate and the inflation rate, as you're asking about, should be. But there's something about 2%, which is an advantage. It used to be that it was 2%, 2%, 2%, we'd say about it. And that would be an advantage for all central bankers. If we knew the 2% was where we were aiming, it would be good for Europe, be good for Canada, be good for Japan, good for the rest of the world.
How closely does the Fed follow the Taylor rule?
Well, now they're very close. They were off a couple of years ago, a year and a half ago. As I said, the inflation rate was about 9 or so. The interest rate was only 0.25, so they were far off. But for the most part, during this successful period, they've been pretty close. And they were hit by this shock for sure, which is a damaging effect. And they could have come back a little more quickly. But I think the value that they've chosen, they seem to have chosen that they're described. They have the tail rule in their reports right now. If you look at the annual report, it's right there. The central bankers know about it. So, by the way, I mention it a lot because it's been around for a long time, and it's really where my research has driven me. But it's not the only way to think about policy. It used to be Milton Friedman, who was a colleague of mine here at Stanford, thought about money growth as a better way to do it, but he didn't react negatively to the interest rate either.
I'm going to come back to that actually in just a bit. So the current Taylor rule stipulates that the interest rate, the I, should be what?
It should be about a little lower than it is now. I
Okay.
think a little
And
lower, yeah.
should we, so like 4.25, four and three
No,
quarters?
it's really not so precise. We don't know what the inflation
Okay.
rate is. We don't know what the GDP level is, but I would say lower.
Now, if we do go,
By the way, I'm not chair of the Fed. I'm not on the Fed, so I don't have to say the exact value.
Jerome Powell doesn't say the exact number all the time either, so we can forgive you, Professor. Professor, so suppose we do have a lower interest rate. What is the Taylor rule supposed to ultimately achieve? Is it supposed to bring the inflation rate down to or aligned with the Fed's target, either up or down? Is that the ultimate objective of this rule?
Absolutely. Keep the inflation rate close to 2, and that's good for stability as well. You know, one of the big damaging effects is the inflation gets too high, and then you have to have a slowdown, which we've had recently. But the main thing is to keep it close to 2. It's not rocket science. It's not exactly going to be 2, but it's close to 2. And the financial markets can have some comfort that the inflation rate will be around 2, and that will affect pricing of everything else.
This does raise an interesting point as to which is that or an interesting question, which is what the long run equilibrium interest rate should be. So let's assume, for the sake of argument, that the current inflation rate is 2%. Well, P will be 2. Let's assume that R is also 2%. Therefore, the inflation gap is 0. So 0.5 times 0 is 0. Let's assume that the deviation GDP, the deviation from the actual GDP to the target GDP is minimal or negligible. So that should be 0. Then in that case, I, according to the Taylor rule, should be 2%, meaning the interest rate should equal the inflation rate, should it not?
Should be, no, you need a little bit more than that. You need
Okay.
about, maybe say two. Two, there's a debate about whether it should be one or two, but I would say two. Two is where it was originally.
Right. So
Two works fine.
so then
Two plus two is four.
according to your rule, then can bond markets and participants and investors assume that the long run equilibrium rate should be a lot lower than what it currently is right now in the markets?
Yes.
Okay.
At least for the Fed and other central banks, the ECB was behind. I think Latin America is behind. We need to catch up, and it depends on each country, but I think there's a great deal of emphasis on some kind of rule, some kind of strategy. So it's not you just don't wing it all the time. You have a sense of what's going on, and I think that's what the rule generates.
Do you see or predict any systemic shocks to either the supply chain or the economy overall next year that could drastically boost inflation and therefore change the Fed's course of cutting rates?
I don't see that at this point. I think the main worry is that there'll be a recession. There's a lot of people talking about that, and I don't think there will be. I think the Fed has adjusted sufficiently. They were behind, but it's adjusted. So I don't think that is a problem. But by the way, there are always risks. There are always things that can occur. They can occur from abroad. They can occur from things besides monetary policy. We haven't mentioned fiscal policy, but the deficit and regulatory policy is very important. They can affect the economy. I think of monetary policy as really one of the important drivers in fiscal policy and regulatory policy, or some of the others. So those have to be on track too, not just the Fed, but the Fed does some regulatory stuff as well.
You mentioned Milton Friedman, an advocate of monetary theory. So, according to Friedman, inflation is always a product of the money supply. Now, have you, through your research, found other variables that have affected inflation to the same degree as the money supply, or do you agree with Friedman that this is the sole cause of?
So I agree very much. If you look at the high inflation countries now, they have high money growth. There's no question about it. If you look at low inflation, they have low money growth. So there's this relationship between the two. The question is whether that's precise enough and if that's enough to do business. Unfortunately, money supply is hard to measure. It can be high, it can be low. Do you use M1, do you use M2, do you have other measure? And that brings in the debt and other things into account. So I think the focus on the interest rate is a very important way to proceed, and it's worked pretty well. And the more we can do that, the better. But there is a question about using the money supply. I think if the money supply is way off from what Friedman suggested, there's something to think about.
Would you go as far as to say that other variables, including energy prices, are just ancillary and not really core to the inflation argument?
You know, the so-called Taylor rule didn't start with just two variables. It started with many variables, and the idea was to find something simple. I was surprised it could be so simple as just really two or something like that. There was energy. Certainly, it was a big factor, and there's what's happening to the exchange rate was a factor. So many people, and they still think about other things that come into play. What I think is reassuring and maybe surprising in a way, maybe people still are getting used to this, is that the inflation rate itself is a big deal, and then some measure of the unemployment rate or some measure of GDP gap is important too. That tells you where you are relative to normal, how fast you should approach the equilibrium inflation rate. Now, there may be other factors that come into play, and I think what the reason I mentioned the money supply and Milton Friedman, of course, that was a rule, that was a strategy, keep the money growth constant. And it's the Taylor rule doesn't have the money growth constant, it has interest rate adjusting by ways which are not inconsistent with the money supply, but it's a different approach.
Well, speaking of the money supply, the M2 money supply growth has been negative for a little over 6 months now. I don't recall the last time it's been negative in terms of growth. I think you'd have to go back to the 30s if I'm correct. Now, Professor, does this worry you?
No, it doesn't really worry me so much, but remember it was high before then. And so in some sense, it's maybe catching up. It just shows you why we need to look at other things. I wouldn't say ignore the money supply. The Fed produces the money supply. They have quantitative easements related to the money supply. But there's other things to keep in mind. What I would say, though, is that the interest rate is a more reliable indicator. It's something that the financial markets think about. Is the term structure, which you know very well, means the longer rate depends on the short rate. So part of the impact is the expectation of what the short rate will be in the future. That affects the long rate, and all those things come into play.
Looking ahead now, you mentioned that many people do think that there is going to be a recession next year. Is that a view that you share?
No, I think I don't share at this point. I think if we're follow monetary policy as so-called Taylor rule suggests, I don't think we'll have one. But there was a risk, to be sure, with the interest rate very low and having to catch up. I think we're okay now. Other central banks seem to be following the same thing. I think we're okay. It may be the hope that I have is well faster growth. And the growth has been very low in the United States compared to where it could be. It could be 3%. It could be 3.5%. And I think that's really what the focus should be. But don't forget, that depends on fiscal policy. It depends on regulatory policy more generally, not just monetary policy.
Why do you think growth should be at 3%, Professor? I mean, what's wrong with our current growth rate?
Well, if you take zero, well, what's so bad about zero? Zero is there's no improvement in standard of living. It's a stagnant society. One is a little better than zero. Two is a little better than two. And three is better than all those. And if it gets too high, then is it sustainable? Do we have productivity that's sufficient to generate that high growth rate? And there's a lot of questions about that. There's a lot of technology coming on, a lot of improvements that are coming on that make it possible to have a growth rate like 3%.
So it's an
And
issue of,
but 10% is not realistic. 10% is not realistic at all.
well, I mean, China has had high single-digit growth for more than a decade and a half.
Correct.
It's come
But
down.
remember,
Not sustainable.
their standard of living is so much lower than the United States, so they have a ways to go and ways to
Right.
pick up, and their growth rate hasn't been so great in the last few months.
So for a mature economy like the US, what should the sustainable growth rate be for GDP?
Well, it depends on productivity. If productivity is more inventions coming on and that's goes through the marketplace very quickly, then we could have a higher growth rate. And I think that's why I mentioned regulatory policy so much and fiscal policy. It's not just monetary policy that generates that. Monetary policy, in a sense, takes as given I would say, the potential growth rate of the economy, whether it's 3% or whatever, and works around that, provides the right support, the right system in place to make that happen.
Okay. I'd like to ask you about the labor market. In the beginning of the interview, you mentioned that the unemployment rate is low by historical standards. In fact, the latest print came down to 3.7%, down from 3.9. So it's been hovering around that range for a couple of months now. Do you think that this number will improve, meaning come down, or do you think more unemployment will hit the markets next year?
I think the rate is doable, around 4% or something like that, 3.9, 3.74%. It's doable. And that should be consistent with the rest of the economy. If for some reason there's a change in the labor market, we have a change in minimum wage laws, I'll talk about that, then I think that's something to look at and take into account. But for the most part, the unemployment rate has been quite consistent with the inflation rate coming back to 2.
I actually had a chance to interview Claudia Sahm, who founded the Sahm rule, and she said that she expects the Sahm rule to be broken, meaning that she expects the unemployment rate to go above 4% and trigger the rule, which is that if you go above 0.5% on a 3-month moving average from the bottom, then the rule will be triggered and we'll have a recession. She expects the unemployment rate to go above 4%, but have no recession. Do you more or less agree with this analysis?
Well, it's certainly possible that that's the case. I think there's always a risk that the interest rate will not come down fast enough. There'll be anticipations it'll come back. I'm not familiar with that particular way to think about things so much, but the main thing is we have an inflation rate of 2%. That's what we're aiming. What's wrong with that? And we have an unemployment rate of 4%. That's okay. What's wrong with that? I think that's a pretty good world to live in. And there's other things that the exchange rate is a factor. There's no question about that. And people focus on the exchange rate a lot. I don't think the Fed needs to do that very much. And other things, some of the remember, It used to be we look at all sorts of things, 10 variables. When I first started studying the subject, it was at least 10 you had to look at.
What do you think is the Fed's priority right now? Is it to reduce inflation or prevent a recession, or are they not mutually exclusive?
It's not mutually exclusive. If they bring the inflation rate down to 2% in a reasonably coherent way, there need not be a recession. There could be a slowdown. There's always a tendency to slow down as you're reducing the inflation rate, but it's not necessary. And I think that's the main thing that they should, their goal should be a smoother running economy, 2% inflation. And we have whatever the growth rate needs to be, the growth rate of the economy needs to be to get to that 2%. We should have that.
What should their optimal monetary policy be in 2024 to engineer a soft landing?
Well, I'm a fan of the Taylor rule. It's been around for a long time, and I think if they keep close to that, they should be fine. And it's in their reports. They all knew about it. They focus on it, and the financial markets focus on it, and other countries focus on it. It's not the only way to do things, but that's what I would feel most comfortable if they bring the rate down according to the Taylor rule. Sorry to say Taylor rule so much.
No, that's okay. It is called a Taylor rule, so
Okay.
we don't have to call it anything else.
Why I don't know, but that's what it is. Yeah.
Suppose they bring it down to lower than what the Taylor rule stipulates it should be, which is to say that they overcut. What is the risk there?
Well, then the risk is the inflation rate doesn't come down to 2. It goes back up again. It could be 3, it could be 4. Why did we have 9.1%?
But they stimulate more growth that way. Is that right?
Well, there's a temptation to have more growth, but the inflation rate is the primary objective of the Fed and other central banks. And if they forget that, it's bad for growth. You look at the countries which have low growth rates, they frequently have high inflation rates. So the important thing is to keep the inflation rate in line, is 2% average or so, like that. If it gets too high, you have to raise interest rates. If it gets too low interest rates. And that's worked pretty well. We've had a good record of central bank policy for a long time with Greenspan and Volcker, and it's worked pretty well.
There's been some criticism to the Taylor rule, according to some academics. Actually, Bernanke wrote that the Taylor rule provides no guidance about what to do when the predicted rate is negative, as has been the case for almost the entire period since the financial crisis of 2008. He wrote this several years ago, of course. How would you respond to that?
Well, occasionally the rate will hover around 0, and there's a question about whether it should be negative. I think it's worked pretty fine the way it's worked now. You just don't let it get to that level. But the danger is not the negative rates. The danger is 0.25 when it should have been 4 or 5. Actually, they're talking. Mickey Levy had a piece in the Wall Street Journal this week. He says, I'll read it. Having stumbled with its discretionary policy approach, the Fed should consider adopting a more systematic policy guideline like the Taylor rule, right there. And everybody else is talking about it as well. And so I think that's the goal, is to have a more systematic policy that people understand. There's less guessing. And I think that's what they ought to be trying to do. And there'll always be criticism of rules or strategies, people trying to do better. But as long as it works, we'll be better, in good shape.
How coordinated are the central banks globally? So suppose the Fed were to cut by 2 or 3 times. Let's just make that assumption. What is this Canadian central bank going to do? What is the ECB going to do? So on and so forth. Do they more or less need to match monetary policy or not?
Well, they're independent central bankers. Christine Lagarde is, for example, ECB. But there's a tendency for them to move together. And part of the reason for that is the interest rate itself. So the interest rate in the US is high and low, then it causes distortions. So it would be better if there's some coordination between the central banks and with Japan, China even as well. And I think that's what the hope is. And to some extent, the mistake recently has been not just the Fed, but other central banks have gotten behind, and Latin America still has to catch up. Europe is catching up fast. Bank of England is catching up pretty fast. But I think to some extent, I know it sounds strange, but it would be great if there was some certainly coordinate. And they meet all the time. They know each other. I used to work in government several times myself. I know these people very well. And so you have a sense that you have a similar goal and a similar strategy, and you know what the other strategy is. It's important to know what the other strategy is.
I think market participants are anticipating, we're trying to guess how many cuts we're going to get. And I keep going back to this question because people are wondering about it. Is history any guide at all? In 2019, for example, 2020, they cut by 200 basis points. 2008 was obviously an anomaly, but they cut by 500 basis points all the way down to zero. Are historical precedents important?
They are. These decisions are made by the FOMC, and so what is influencing them is important. But I think what is most important now is some kind of a strategy, some kind of a, I'll call a rule if you like. And so you kind of know what the central bank, you know that their target is 2%. If they got far from that, there's something that's got to change. You know what the target for growth rate is going to be. Maybe it's 2%, maybe it's 3%. And so that's a communication strategy. And it's not just communicating with the markets, it's communicating with other central bankers. So we know exactly as much as we can what the central banks were doing in other countries as well. And I think the big strategy going forward is what's going to happen with Russia, what's going to happen with China, what's going to happen with other countries that are not part of the system at this point.
Now, I heard, and I'd like to get your opinion on this. I heard that the Fed has an unofficial third mandate, which is the financial markets, which is to say that the financial markets see some sort of meltdown. If the stock markets collapse, they would have to ease monetary policy. Is that true?
Well, it's a factor. If they're looking at the way the markets are operating, they're looking at and to some extent, if the market collapses, it's a sign that the economy is going to collapse as well. It's not completely independent. So that's a factor that they're thinking about. And I think they should. The financial markets are very important. And as what I mentioned a little bit, the longer rates or short rates, sometimes the longer rates will rise in anticipation of a future short rate rise. And so those things are taken into account, and the exchange rate as well. So those are all very important financial market factors. It's not just the US, it's other countries as well.
Finally, I'd like to finish off on your work. So we started by talking about, we're referencing your book, Getting Monetary Policy Back on Track. Can you give us a little bit of information about what we can expect to find in this book, in particular, why they were off track to begin with?
Well, they got off track because who knows the reasons, but they got off track. One of the things that's very important when you think about monetary policy is why did they get off track? What's the reason for that? And here I think you have to think of political reasons. There was appointment reasons, different things that come in mind. There was also the important thing of COVID, how that was affecting things. So they got off track, but the main thing, they got back on track reasonably quickly. And I think that's a very important thing. And so there will always be periods where central banks get off. But my message is get back on track as fast as you can, is the most appropriate way. Don't do any damage, and things will work better if that's the case. And people are writing about it more and more. They're seeing this experience that we've had recently, and they're trying to add it to, should we do things differently or not?
Now, I've heard from some analysts that whoever takes the office in the White House next year, whether it be Biden or Trump, you're looking at a second-term president. Second-term presidents historically have had less of an incentive, if you want to call it that, to really aggressively grow the economy because it is their last term. If this were the case, Professor, would this impact monetary policy at all?
I think the main thing that the next president needs to think about is how to make sure that monetary policy keeps the inflation rate down, but then we have faster growth. And faster growth is less regulation or different types of regulation. It's fiscal policy. One of the things we've not talked about at all in this interview is fiscal policy. It's gotten off track. And so those things that I would point to the White House as concerned, not just with monetary policy, but with regulatory policy and fiscal policy. And don't forget international policy is an important role of the G20 and other countries as they investigate what to do.
Well, let's touch on that briefly. The effects of the fiscal policy on inflation. One could argue that it's just as important, if not more so. What's your take here?
Well, of course, it has a big impact. This is where how much of the deficit does the Fed accommodate? How difficult does that make the Fed's job? It makes it more difficult. But I think the Fed should focus on the interest rate and inflation rate and the state of the economy and say, say the right things about fiscal policy. But I think what I would stress as a general economist, not just a monetary person, is fiscal policy and regulatory policy and international policy, all very important. I think don't forget about those. Very important. We can talk about monetary policy. I've done many books, many theories. I have textbooks. I teach it all the time, but it's not just, it's just it's part of policy more generally.
Have you done any research on the optimal debt level or deficit level that is sustainable to growth?
Yes, the optimal level is you have zero. You have
Really?
a deficit close to zero, and it increases in recessions and decreases in slumps. So it's somewhat cyclical. It has to be cyclical because people pay more tax when the economy is going well and less tax when it's not doing well. So that's an important part of our so-called automatic stabilizers that we have in place.
Does the government not need to overspend sometimes in order to stimulate growth?
No, I don't. I think that my own view, this is somewhat controversial, perhaps, is that fiscal policy should keep the balanced budget as close as possible. There are other things going on. There's other things that demand for policy, but we shouldn't think of fiscal policy as a stabilizing device. I think that's really where we can make errors.
Finally, you're also, well, you've won a number of teaching awards at Stanford. You published several economics textbooks. You were telling me offline you're still teaching intro to economics course. What is your approach to teaching? What are you trying to achieve with the education part of your work?
I think, first of all, just basic economics, microeconomics, supply and demand, macroeconomics, the money supply, the state of the economy, and international economics. I divide the course into micro, macro, and international, all very important. And it's changed over time. As the courses, I've been teaching the course for a long time, teaching at other universities, and you find that there's a systematic policy, which is what we said: stable monetary policy, stable regulatory policy, stable fiscal policy, and stable international policy. And that's what I teach. It's a standard approach. It's not different, if you like. It's really what we've been teaching for a long time, but it has to be different because the world is integrated. And one of the things which I appreciate what you're doing very much is where the world is integrated. It's more and more connected. And things like these rules or strategies are a way to make sure it's connected in the right way, not in the wrong way. And I try to emphasize that with my students as much as I can.
Well, when you're talking to people in the general public, not necessarily even your students, but outside of academia, people in your meeting, your personal or professional lives, what are some of the biggest or most common misconceptions about economic growth and inflation that you hear?
Well, partly is that we just should have high inflation, it'll be fine, but that's fairly rare these days. People said that several years ago. I think the main thing is how much regulation there should be. And fiscal policy is international policy. International policy is one where there's so many factors that come into play: what the exchange rate policy should be, what your international trade policy should be, what your international financial policy should be. A lot of disagreement about that. But I think as we get the monetary policy, fiscal policy, and internal regulatory policy on track, we'll be in much better shape, not just the US, but other countries as well. And that's what I would focus on. That's what I do focus on.
Final question for you, Professor. You've not only had a long career working in academia and and research and working with the Federal Reserve, as well as the U.S. government. You've had experience coordinating international affairs as well. So you've been the Undersecretary of the Treasury for International Affairs. Throughout the early 2000s, you managed oversight of the IMF and the World Bank. Given your experiences in these particular fields, what do you think are the major risks that the global economy faces today, and how should we mitigate these risks?
I think the major risks are that there's less coordination, that there's less focus on let's do the right things. The IMF and the World Bank have an opportunity to do that. The IMF especially, have known the people over the years, but it's maybe other sources as well. You have the European Central Bank is a way to coordinate policy in different countries. So I think the main thing is to follow the policy, good monetary policy, good fiscal policy, good regulatory policy, and good international policy. And international is where the the institutions you're referring to have a very important role to play. And I hope they don't get off track and continue to play that role going forward.
Okay. Where can we follow your work, Professor?
Everywhere. Okay, I'll hold up my latest book. There we go. Principles of Economics. I don't know if you can see that. It's just out. It's the 10th edition. 10th edition. How about that? And that's what I use in my course, and I'll continue to do that. We'll see how long it lasts. And there's intermediate micro. There's also, and don't forget the Wall Street Journal.
How's your class doing so far? What's the average grade for this semester?
I can't tell you the average.
Okay.
They're doing very well. They're doing very well. I'm very pleased, very happy to be part of it.
Well, your students are very fortunate to be studying with a living legend like yourself. So thank you for continuing to teach and educate the next generation. And I look forward to speaking with you again. So thank you for being here, Professor, and have a happy New Year.
Same to you, David. I enjoyed the conversation very much. Bye-bye.
Thank you. And thank you for watching. Don't forget to follow Professor Taylor in the links down below and subscribe.